Hello, everyone, and thank you so much for attending week 2 of BFSG's 4-part summer webinar series. This week, discussing the differences between traditional pre-tax and Roth after-tax savings in retirement vehicles. A few housekeeping items as we begin today. There is a Q&A box, as usual, in the Zoom menu, which is distinct from the chat box. Please type all questions into the Q&A box throughout today's presentations, and we will respond to all questions at the very end of today's presentation during a live interactive Q&A with the audience. For compliance purposes on a live and recorded webinar, we will not be unmuting lines, so please type your questions into the Q&A box. Should your questions be more personal in nature, we will provide contact information at the very end of today's webinar and encourage you to reach out directly rather than asking personal questions on a live and recorded webinar. As usual, an on-demand replay link will be provided within 24 hours directly from Zoom in case you would like to listen again or share with friends and colleagues. And we will also include a link in the chat box today, as well as sending directly from BFSG tomorrow to the PDF slide deck so that all of you can have a copy if you would like to download. With that, my name is Chad Narani, a retirement plan consultant here at BFSG, working with their institutional clients. Mike, you want to introduce yourself?
Yeah, thanks, Chad. I'm a senior portfolio manager and certified financial planner with BFSG. I've been with BFSG for over a decade, helping clients create a financial roadmap and ultimately helping them achieve their goals and objectives.
Arash.
Hi, my name is Arash. I am a CPA and a certified financial planner. I'm one of the wealth managers here at BFSG, and I'm also the company's controller.
Thanks so much, Arash. So before we kick this thing off, I do want to comment. I know we have a lot of participants from institutional clients today. If you have any questions specific to your retirement plan, be it a 401k, 403b, 457, whatever that is, please email those directly to me. That's chadn@bfsg.com. And I will touch base with you to answer those questions offline, as there are participants from a variety of retirement plans and the public all on this webinar today. So let me kick this off with a very common poll for everybody, just to gauge the audience on whether we already know the differences, or at least the basic differences between traditional and Roth accounts. I just launched polling now. It should show up on all of your computer screens. I'll leave it up for about 20 seconds as we gather responses. Great, so with most responses in, I'm going to end polling. I apologize for any of you that are coming in at the last moment. I will also share results with the group. So it looks like we have a pretty close split, about 40% yes, 40% saying some, but looking for more details, and about 20% saying no, that's why I'm here. So hopefully this will be a really good presentation for the group. We're going to cover the basics for all those that don't know. We will definitely go into some big details, a lot of more intricate details and more complicated stuff during today's presentation. So let me kick it off just really talking about the two basic ways that you can save in a retirement account, right? So on the left-hand side, the most common is traditional or pre-tax contributions. And what those are is you pay no taxes today, which reduces your taxable income. The money then grows tax deferred in your retirement account, be it any employer-sponsored account or an IRA. And then you pay taxes when you withdraw money from that account at retirement, right? So that big footnote at the bottom, they are not meant to be size 8 font that you never read. We do want you to pay attention to every footnote in this report. The first bullet point says those withdrawals, if you take them before age 59 and a half, may be subject to a 10% penalty plus income taxes. And for all of those, this is a nationwide audience today, but for those of you living in California, you're actually subject to an extra 2.5% tax that the California state imposes.
That's the sunshine, right, Chad?
That is the sunshine tax. So then Roth on the right-hand side of the page here, are after tax. So you pay taxes on all those contributions today. The money then grows tax-free instead of tax deferred, right? Tax-free, and then you pay no federal taxes when you withdraw the money at retirement. So then again, there's a footnote at the very bottom, the 2 stars, the withdrawals are tax-free provided that they meet a second provision, right? At least 5 years after the date of the first Roth contribution was made, and then also that age 59 and a half or the really morbid death or disability. So if all things were equal, right, is the first question, like what is really the difference between saving pre-tax or after tax? So if all things were equal, I'm going to put some numbers on the board. But before I do that, I want to bring your eyes to the very bottom of the page to look at the assumptions, right? And so we're going to assume for a 40-year career from age 40 to 70, somebody makes the exact same salary, right? So we recognize $100,000, most people start off making much less than that, maybe make more than that, later in their careers. But for simplicity purposes, assume you make that exact same salary your entire career. Your pre-tax annual deferral rate is 10%. Your Roth deferral rate is 7.5%. I will address that in just a minute. And your contribution effective tax rate is 25%. So I just put at the very top of the screen, the reasoning for that difference in Roth savings, right? So at 10% of $100,000, you'd be saving $10,000 per year. But in retirement, right, there'd be a $2,500 tax on that. So if you were saving Roth instead, you'd actually pay that contribution tax rate of 25% immediately, which would drop that contribution only 7.5% that you'd actually be saving in the plan, right? It still costs $10,000, but $2,500 would go to taxes, $7,500 would go into your account. Right now, the really big stipulation is the last item under assumptions, the very third line, assumes the withdrawal tax rate while you're taking money out is also going to be 25%, right? So 25% tax rate when you worked, 25% tax rate when you're in retirement. We assume you make 7% on your money per year, and this account only needs to replace 60% of your income in retirement. So that traditional account, right, pre-tax would grow to almost $1 million over 40 years at that, under these assumptions. And then that account would actually last you until age 96 at a 25% withdrawal tax rate as well. And so what happens if it's Roth? Obviously, you're only putting $7,500 into your account. So that only grows to about $700,000. But you pay zero taxes on the way out, where that pre-tax bucket was paying taxes on the way out. So that would actually last you under the exact same scenario until age 96. It would actually deplete your account the exact same day, the exact same time, all things being equal.
Chad, my younger son's already learned the hard lesson that all things in life are not equal. So what if I'm in a higher tax bracket during retirement?
Good question, Mike. So that brings me perfect to our next slide. So again, I'm going to do the exact same thing, but there's a big difference at the very bottom of the page under the assumptions. You'll notice the second line, all those are the same salary, same pre-tax deferral rate, same Roth deferral rate, same contribution tax rate of 25%. But what if when you're in retirement, the withdrawal tax rate is no longer 25%, but it goes up to 35, right? It could be for any reason. Maybe you're taking more money out in retirement than you were making pre-tax because you've been a really good saver, you're traveling more, et cetera. Or maybe the government needs to raise taxes for whatever reason, right? So that's the only difference is that bold, the third line down. What you'll notice is throughout your career, your traditional assets would still grow to about $1 million. But on the way out, instead of paying 25%, you're now paying 35%. And that means that those assets would actually deplete at age 89 under this scenario, where the Roth bucket would grow to the exact same $700,000, and you would have paid 25% taxes the whole time, same as the last scenario. But then in retirement, that increased tax rate of 35% has no impact on those Roth assets. So it still lasts you until age 96, right? So keep in mind that could work reverse too, right? So we said a higher tax rate, but what if in retirement, now that you might have already paid off your house, you have no mortgage payment for any reason, maybe you need less money in retirement. In that scenario, that traditional bucket would have actually lasted longer than age 96, right? So at the end of the day, it does turn into a game, which we will address in great depth later in this presentation, about what you think your tax rate is today, what your tax rate will be in retirement, and figuring out kind of the best place for you to diversify all of your assets. So before we get into some of those details, I want to set some expectations for people in their working life, right? So the left-hand side of this chart, looking at the purple bars, how long can you expect to work and save in your retirement account, right? And so, what the left chart is doing says, well, for expectations of workers currently working, not age 65, about 71% expect to make it until at least age 65, if not longer in their working careers. The second bar, though, those people already turning age 60, or already retiring, is the actual experience is that people actually retire less. Only about 30% actually make it to age 65. And so the very bottom box says, well, most people expected to retire at age 65, but most people actually retire at or around age 62. So when you think about that, that's 3 years that instead of saving in your retirement account, you'd be withdrawing from your retirement account. So say you would have been saving $10,000, instead you're withdrawing $50,000. That's a $60,000 swing in your retirement savings for 3 years to make it all the way through your retirement. And what are the biggest reasons for that, right? On the right-hand side, the very top two are the only two I'll touch on for the reason people are leaving is health problems or disability, right? Or changes at the company, right? Downsizing, whatever it might be. So it's not that people didn't want to work till age 65. It's that for one of those reasons, they just couldn't. Now, hopefully for all of you on this call, especially you're working with BFSG, going through all these programs and listening to these webinars, you're one of those green boxes at the very bottom and just says, you were able to afford retirement or you just want to do something else, right? That's the goal between going through all these exercises, listening to all this content and saving as much as possible in retirement, right? So putting some perspective on that though, whether you make it to age 65 or retire at age 62, how long might you be expected to live and have to sustain yourself on your retirement savings? Right, so what this chart is now showing at the bottom is ages, 75, 80, or 85 years. On the left-hand side is the percentage of people that already made it to age 65 and how long they could expect to live. Right, so we understand that some people might not make it to age 65 in the first place, right? Some people do pass away early, 45, 55, that's an unfortunate reality. But for those that do make it to age 65, purple represents women, gray represents men. Interesting that women tend to last substantially longer than men. And green represents couples and the probability that at least one person in the couple will make it to that age. So I think for all of you out there, that have a spouse or significant other, the probability is almost 50% that at least one of you is going to live to age 90. So even if you make it to retire at age 65, that's 25 years that your retirement savings and Social Security will have to sustain at least one partner throughout the rest of their retirement. So with that, let me get back to the pre-tax versus Roth contributions. And so think again, to summarize, right? Pre-tax contributions, tax deductible today, earnings compound on a tax deferred basis, and then bright blue withdrawals at retirement are then taxable. And then we always have that disclaimer right there. So Mike, being a financial planner, right, portfolio manager, can you tell us what are some of the reasons somebody would consider pre-tax?
Yeah, typically you would favor pre-tax if you think your tax rate will be lower at retirement. So if you're a high earner, this is an appealing aspect of pre-tax accounts, since you'll likely be in a lower tax bracket when you retire. Furthermore, pre-tax deductions reduce the amount of income you have to pay on taxes. Again, another bonus for those high earners or others needing tax savings now.
Awesome. Thank you so much, Mike. So I'm doing the same thing on Roth, right? So again, to summarize, they are not tax deductible today. You will pay taxes. But then again, those two big bullets, qualified withdrawals are tax-free, assuming both of these are met. So one, the first Roth contribution to your account was made at least 5 years before, right? So if you're age 62, planning to retire at 65 and pulling money, maybe don't start your Roth account today because you actually wouldn't be able to pull it without penalties until age 67, right? But for all the rest of you out there that have more than 5 years, I would even consider funding a Roth account, even with just $10 and put it in there in cash and let it sit there. So you already have a Roth account established and you started that 5-year clock, right? And then the second bullet, this is an and, you must be, again, at least age 59 and a half, or you had the more morbid things of becoming disabled, passing away, et cetera, those things that nobody wants. Again, in retirement, bright blue, you do not have to worry about future federal tax rates. So with that, Mike, with those things in mind, what are some reasons somebody would consider a Roth account?
Yeah, pretty much just the exact opposite of what I said for tax. You would want to consider a Roth if you believe your tax rates at retirement will be higher. So typically that's going to be younger clients with a long runway until retirement and with expectations of hopefully future income growth. They're going to be the ones favoring a Roth account. Roth accounts are also great wealth transfer vehicles for estate planning purposes because we're going to touch on this later. There's no required minimum distributions on Roth accounts. And note, there are income limits for Roth IRAs, again, which we'll touch on later, but you can get around these limits with something called a backdoor Roth IRA. We're not going to go too much into detail because it's more complex, but it's best to discuss that strategy with a trusted professional. And finally, the last bullet point here, what you'll see is there is a link there and it provides you those income limits. Again, we're going to talk about those later, but there's an exception to the income limits by using what a in-plan Roth in a retirement plan. Again, we'll get into a little more detail later on.
All right, so in putting these, the last two slides together, like when would somebody consider, right? So lower incomes, ages, right? All, higher incomes, ages, all things go into that. So can you kind of walk through on this next slide, kind of the scale about when somebody might think about one of these? And again, noting that while it says 401k on the slide, everyone, this does apply to 403b plans, 457 plans, and individual retirement accounts.
Yeah, good clarification, Chad. So what we always recommend, I don't want to say always, but we recommend having both pre-tax and after-tax accounts because when you reach retirement, you have more levers to pull for tax bracket management when you start drawing on those accounts. So let's look at this chart. On the horizontal axis, you've got age. on the vertical, you've got annual taxable income. And so as I mentioned previously, when you're younger and maybe your annual taxable income is lower, it's probably better to favor Roth accounts, either in a retirement plan or a Roth IRA. And then as you progress in your age and hopefully your income is growing, you might favor either pre-tax or after-tax, or maybe both. And then when you're in your peak earning years, which is that blue section of the top of the graph, and when your income's the highest, and usually that's at the peak of your career before retirement, you need those tax deductions and you're going to favor pre-tax. Upon retirement, there might be a window of opportunity, which is the number 2 there, circle, where before you start drawing on pension income or Social Security, say you've delayed that, there might be a period where your income drops substantially because you don't have earnings anymore and you haven't started collecting on those entitlement programs or pensions if you're lucky to have one. And in that window, you can maybe do Roth conversions where you take some of that pre-tax money and convert it into a Roth. You pay the taxes today, but then you save on taxes later on when you start drawing those funds. And that's usually the window before you start taking required minimum distributions at age 72. And we're going to walk through a couple of examples specifically on that.
Awesome. So think about that conversion that he just talked about. I think that's where we're going with this next slide. Some big considerations to consider.
Yeah, and we really want to point out you don't want to make any mistakes doing this because it can be a great tool and strategy, but there are some pitfalls. So we're going to walk through those. So, for example, let's just take someone, a single person making a salary of $80,000, and they have a Roth that is about $200,000. They decide to convert that entire balance. All of a sudden, their taxable income jumps to approximately $270,000 after deductions. And that's because the $200,000 Roth conversion, it's all treated as ordinary income in the year you convert. So that person would jump from 28% effective tax bracket roughly to about 35%. Out of pocket, you need to come up with $77,000 roughly to pay for that conversion. And just note, you want to be strategic with these Roth conversions. It's not an all or nothing. You can do a partial, you can do it over a period of years, but you do have to come up with that money out of pocket come tax filing time. And the other important thing is you cannot reverse this decision. So once you go forward with it, then you, again, make sure you have the money to pay for that conversion. So I'll just go a little more extreme example, looking on the right, the same single person, but they're making $400,000. They have a Roth of roughly $1.5 million, and they convert all of that. So they go from an effective tax rate already pretty high at 41 up to 48. And out of pocket, that person is going to have to come up with roughly $745,000 out of pocket. That's almost half of the full conversion amount of $1.5 million. So again, just think through these things. It's not all or nothing, and you cannot pay taxes directly from the plan or the Roth IRA.
Yeah, Mike, I'd like to reiterate that before we move on. It's a really big thing. This is an irrevocable decision. So like we are huge proponents of Roth conversions for the people it makes sense for out there. But just be strategic, right? There's no reason to convert, $200,000 or $1 million at one time and boost your taxable income. You can work with your accountant, your CPA, and your financial professionals to strategically make those conversions over a number of years, maybe $10,000 a year or $20,000 a year, and limit your tax liability to the lowest tax bracket possible. Again, it needs to come from some outside savings or investment account. It can't actually come from your retirement account unless you're already over that age 59 and a half and want to take a distribution to cover the tax bill. So the IRS is going to figure out a way to get paid those taxes if you make that decision. So definitely something to think through. Work with your financial professional team to do it in a tactical manner.
Yeah, and unfortunately, I think Einstein said it, death and taxes are the only two certain things in life. So while you pay taxes on these conversions, you just want to be strategic about it and make sure you don't bump yourself into a higher tax bracket.
Yep. So with that in mind, I think we're talking about people that have already saved $200,000 or $1.5 million on this slide. I know a lot of you out there saying, okay, well, I would love to accumulate that much money. Arash, can you talk to us about some of the contribution limits for the different types of accounts out there and how people might be able to maximize their retirement savings?
Sure, Chad. First of all, I hope everyone can accumulate $1.5 million in their accounts. And the way to do that starts really by making contributions. And this is a topic that comes up quite often with our clients. They like to know how much they can put annually into their retirement accounts. The limits are actually the same for both pre-tax account and Roth accounts. So for retirement plans at work, like the ones that you have at 401ks or 403bs, the annual maximum contribution is $19,500. But if you're over the age of 50, the IRS allows you an additional $6,500 catch-up contribution. So your total would be $26,000. Basically, IRS recognizes that you're getting closer to retirement. They want to help you save for retirement, so they allow you that additional contribution. And when it comes to IRA accounts, the annual maximum contribution is $6,000. And if you're over the age of 50, there's additional $1,000 catch-up contribution. So you're allowed a total of $7,000 to put into that account. Again, the limits are the same for pre-tax accounts and Roth accounts. But there are a couple of things to keep in mind when it comes to these contributions. First of all, you have to have earned income. So your earned income has to be at least of the amount of the total contribution. So let's say, for example, you only work part-time this year and you made $5,000. That would be the total that you can contribute to an IRA account. So you can't put $6,000, you can only put $5,000. And also,
can I give an example on that? I know some people are out there probably going, wait, well, how would I even contribute $6,000 if I only made $5,000? And the idea there is that there's some people like maybe you only made $5,000, lost your job, or moved to part-time for any number of reasons out there. But you could also still have savings, of several $1,000s in a savings account. Maybe you say, even though I work this, my spouse still made money, I can still afford, to live and save. So I still want to put that maximum $6,000 in my Roth or pre-tax IRA. And what this is saying is you can only contribute what you've earned. And Arash will talk about some stipulations on the next slide, but that's what that bullet point is pointing out.
Exactly. Thanks, Chad. And also the next point is that the combined traditional Roth contributions cannot exceed the annual IRS maximum. So what that means is that in total, for example, for an IRA account, you can put the $4,000 to a traditional IRA and $2,000 for a Roth IRA for total combined of $6,000. You cannot put $6,000 in traditional and $6,000 in Roth. And finally, for employer contributions in retirement plans, employer contributions in retirement plans are always pre-tax. So if your employer offers you a traditional pre-tax account and also a Roth account, their matching contributions will always go to the pre-tax account. And if these rules weren't complicated enough, there are some additional rules that IRS has for us in regards to the IRAs and the income limits that apply to the IRAs. So for traditional IRAs, if you and your spouse are covered by a retirement plan at work, you can still contribute to an IRA, but whether or not that contribution is tax deductible has to do with your income level. So for example, in 2021, a single individual who's participant at a retirement plan at work can contribute to an IRA and deduct it for taxes only if they make less than $66,000. If they make more than $66,000 up to $76,000, only a portion of that contribution is tax deductible. And if they make more than $76,000, the contribution to the IRA is not tax deductible. For married couples, the income limit is from $105,000 to $125,000. However, if your situation is that your spouse is covered by a retirement plan at work, but you are not, IRS recognizes that you're at a disadvantage, so they have increased the income limits for a married couple from $198,000 to $208,000. So again, it's important to consider these income limits if you're covered by a retirement plan at work and you're also considering contributing to an IRA account, and make sure that you can deduct it for taxes and have these in mind. But when it comes to Roth IRA account, because the contributions to these accounts are with after-tax dollars, the tax deductibility here is not in question, but whether or not you can actually contribute to a Roth is something we're going to look at. So in 2021, if you're single and you're making less than $125,000, you can contribute to a Roth up to $6,000 or $7,000. But if you're making between $125,000 to $140,000, you can only contribute a certain portion. And if you're making over $140,000, you basically cannot contribute to a Roth account because IRS thinks you're making too much money to be able to take advantage of a Roth. For married couples, the income limit is from $198,000 to $208,000. But as we mentioned, there are some ways to get around it, like the backdoor Roth contributions that we're not going to get into, but we'll likely touch on.
So one more big clarification there, because I know we kind of mentioned if you're within one of those income limits and you can't save to a Roth IRA, that does not apply for all of you that have an employer-sponsored retirement account, right? So within the account, within your employer-sponsored account, assuming Roth is offered, you can still save up to that $19,500 or $26,000 into your Roth money source, regardless of income limits. There's no income. You can make $1 million. It doesn't matter. You can still max out Roth inside of an employer-sponsored account. This only applies to Roth IRAs.
Great point, Chad. It's all about the IRAs in this slide. And moving on from contributions to retirement accounts to distributions, we're going to start talking about the options that you have for retirement plan that you have at work and the distribution options that are available. There are generally 3 distribution options available to you. The first one is cashing out. This is generally not a best idea unless your situation calls for it, because the idea here with these retirement accounts is to allow them to grow tax deferred or tax free, and you want to let it grow for a long time. But of course, life happens and you may need some cash, so you have the option to make a distribution from a retirement account. But keep in mind that if you're younger than 59 and a half, you may be subject to that 10% penalty. And your second option would be rolling over the account to another employer-sponsored retirement plan. So let's say you're switching jobs and your new employer generally would allow you to roll over your previous employer's plan into the newer employer's plan, and you wouldn't be subject to any penalties. Finally, you have the option of rolling over your account into an individual retirement account or an IRA. But when it comes to this type of rollover, it's important to do a cost and benefit analysis, because if you're going to have that IRA managed by a professional, that financial advisor may charge you fees that are higher than your retirement plan, but at the same time, they could provide you services such as financial planning or construct a portfolio that is more suitable to your goals and your needs. So there are things to consider when it comes to these type of rollovers.
Yeah, one other thing, Arash, I just want to add is for rolling over to another employer-sponsored retirement plan, you need to check, like say you've got a Roth in-plan option currently in your retirement plan, you want to roll that over to, say, a new employer. You have to make sure that new employer has that Roth option as well. So just another decision point if that's an option to you.
Yeah, I think it's about 60% nationwide and increasing very rapidly across the nation for employers that are offering Roth, but it still is the thing that not every employer offers Roth in their plan. So something to look into. Of course, you can always roll the pre-tax bucket over if they allow rollovers, and then take the Roth portion and put that into a Roth IRA instead.
Yeah, nice point.
Great point, guys. And there are a couple other withdrawal considerations that you want to keep in mind when it comes to traditional IRA and retirement plans. Because these accounts are generally funded with pre-tax dollars, the IRS wants to collect their taxes on those earnings at some point. So they have a rule in place called a required minimum distribution. So basically at this point, by April 1st of the year after turning 72, you're required to make a distribution on an annual basis. And the amount that you're required to take has to do with account balance and also your life expectancy. And IRS has some tables to help you calculate this amount, but generally when you're getting closer to that age, you want to talk to your financial advisor, CPA, or a custodian to help you calculate the amount, because it's very important to make that distribution. If you don't make that distribution, there's a hefty penalty, basically 50% of the required minimum distribution amount. So you want to definitely keep this in mind when you're getting closer to that age.
Hey, Rash, so as I monitor the Q&A box, we just touched on one of the big questions that came a little bit earlier. So I think the answer is yes. RMDs, for the person that asked that question, are now age 72 as a result of the Secure Act that was passed last year. Note that it was age 70 and a half. So I know some of you out there might not have heard that it moved to age 72. It is 70 and a half for anybody that retired prior to, I think it's January 1st last year, and age 72 for anybody that retired after January 1st last year.
Exactly, Chad. It's good to keep a close eye on this because there are talks on Congress that may increase that age limit. So we're going to see some changes most likely in the next year or so. So it's something to keep track of. But when it comes to Roth IRA account, because these accounts are funded with your after-tax dollars, there is no required minimum distribution. However, there is still a required minimum distribution for Roth retirement plans, but you can simply move across, get away from that by rolling over that account into a Roth IRA. So there are ways to get around it. And here on the bottom, we have some notes in regards to taxes that we already covered, but the notes are here in case you like to review them later on when you get the slides. And moving on, earlier we mentioned that there are a few exceptions to penalties for the early withdrawal penalties that there is in place, that have 10% penalty exception for early distributions. Here is a list that is both applicable for retirement plans and IRAs. And starting with the most depressing of them all is death. So if you die, IRS is not going to require your beneficiaries to take a 10% penalty. And then also, if you're disabled, the 10% penalty is not applicable to you. And a couple of other ones that are generally more applicable to people, and we see them more often, are medical expenses. If your expenses exceed 10% of your AGI in 2021, and you need some money and you take it out of your IRA or your retirement plan, you're not subject to that 10% penalty. And also the rollovers, as we mentioned, is not hit with penalties. And finally, something we see often is taking out distributions to pay for birth or adoption of a child. You're allowed up to $5,000 per child per parent, and you wouldn't be faced with a 10% penalty. But there are other exemptions that's more applicable just for retirement plan and IRAs that Mike is going to touch on.
Yeah,
all right, Mike, before we do that, can I touch on the birth or adoption? So for any of you that have an IRA, as part of, again, the same Secure Act, is that does apply to every IRA out there, be it traditional or Roth. It was an optional provision for employers to adopt inside of employer-sponsored retirement plans. So not every employer has adopted, although most of ours have. So that's definitely something, if you're choosing to do so, if you have an IRA, that's an easy place. You can definitely take that $5,000 out. If it isn't within your employer-sponsored plan, you want to reach out to HR and see if that is an option that is available to you.
Yeah, and this slide is all about avoiding the 10% penalty and the exceptions. You still pay taxes on any withdrawals from pre-tax accounts. And I think this also just highlights the importance of having an emergency fund to avoid having to take any early distributions. So there are a few exceptions that apply only to the retirement plan. The first bullet point there, and this is say like a 401k, 403b, so on, is a qualified domestic relations order, or a quadro. So unfortunately, anyone who's been through a divorce probably knows about this exception. Again, not a fun thing, like going back to death, disability, IRS tax levy, divorce, things you typically don't want to be going through to avoid a 10% penalty. The other big thing, and this is important, is attainment of age 55 and a separation of service. So you can take 10% penalty or avoid that 10% penalty early on, say you have an early retirement. But this consider though, before you roll over your assets to an IRA, you maybe don't want to do that, because then all of a sudden you increase that age from 55 to 59 and a half. And no, you still have to pay ordinary income taxes on the withdrawals. So if we jump to the box on the right, and these exceptions apply only to an IRA, and the most typical ones we see is higher education expenses. So you can avoid that 10% penalty if you take out money from your IRA for qualified education expenses for your family or even grandchildren as well. That does not apply to student debt. The other one is first-time home purchases, but it's only up to $10,000. I don't know if anyone's been paying attention to real estate prices around the nation, and specifically here in California. $10,000 might buy you a cardboard box. So those are the two most common exceptions that, again, they only apply to an IRA.
Thanks, Mike. So as we get close to wrapping this up and opening up for live Q&A, we have a ton of great questions in the queue right now. Let me kind of go through a real quick summary of the difference of all these accounts. So again, wherever it says 401k, it does apply to 403b. It also applies to 457 plans. So at the very top left, you have the pre-tax, both retirement employer-sponsored accounts and IRAs, Contributions have a plus sign, meaning they have preferential tax treatment. The investment growth is also tax deferred, so preferential treatment, but then withdrawals are then taxed at ordinary income, so no preferential treatment. It's right below that, the opposite for Roth accounts, right? So you do pay taxes on contributions, so no preferential tax treatment, but then your investment growth is tax-free, right? All the earnings are tax-free, and then in withdrawals are also tax-free. So fantastic, option there. And then there is one more option, right? We have pre-tax, you have Roth, which is after tax and tax-free earnings growth. There is an option called after tax that's available to very few employer-sponsored plans or a non-deductible traditional IRA, which your contributions are taxed, but the investment growth is tax deferred in those accounts. So there is no taxes immediate. Think if you were to invest in an after-tax brokerage account, just buying and selling stocks or bonds, whatever that is, you pay taxes every year on capital gains and earnings and dividends, et cetera. In one of these after-tax retirement vehicles, all of those earnings would be tax deferred, so definitely preferential treatment. But then at withdrawal, it's similar to being in that pre-tax for retirement account, is that all withdrawals are taxed, including earnings at whatever your ordinary income is at that point in time. So as we wrap it up, anybody that does have questions, we have a big team of CFPs here to be of assistance to answer any questions you might have. If anything comes up after this call and we were unable to address it for some reason, definitely look through kind of your next steps. I do have Mike and Arash's information at the top of the page. They're both financial planners. Arash is a CPA as well. Check out our next webcast next week, Healthcare in Retirement. It will be July 22nd at 10 a.m. Pacific and 1 p.m. Eastern time. And of course, we are always here to help and answer questions and help anybody through any of these more intricate situations that you might have. With that, before I advance it into Q&As, I will drop a bunch of links into the chat box for the group in just a moment. The idea here is I'm going to drop a link to the chat, to the PDF slides. I'm going to drop a link to a 1 to 2 minute survey for anybody that's willing to complete that. Let us know your thoughts on today's presentation. There's a link to register for next week's webinar. I mentioned next Thursday at 10 a.m. And then a link to the back end of our website, BFSG University, for anybody that's interested in any of the content that we published over the last 15 to 18 months, including other things on Medicare and saving for college and all those types of things out there. So with that, I know somebody did just raise their hand in the chat box. Please type your question into the Q&A box. Again, we will continue answering questions as long as they come in. So if you have another question as we go through the Q&A today, please keep typing them in and we will answer them in the order they are received. So with that, let me start with the first question. I think this one might be for Mike, our investment guru on the line today. I'm participating in a small investment that's pre-IPO. Should that company go public, can the stocks be deposited directly into a Roth IRA, or is only cash allowed?
No, yeah, you can invest in a pre-IPO company as long as you can get access to the IPO, which is an initial public offering, typically before a company becomes public. And that's typically in a Roth account is where you want the highest growth potential in that account. So I mean, you would hope that a company going public, IPO, has a good long growth rate in front of it, because as those investments grow over time, remember a Roth, everything comes out tax-free. So you want the most growth potential in that Roth account.
There are some requirements to do this. Like you have to make the purchase. You can't transfer the stock into the Roth. You actually have to purchase the stock once. You have to put cash into the Roth and then make the purchase.
Yeah.
It's be done through a self-directed IRA or Roth IRA. And please talk with a CPA to make sure that the transaction is structured correctly. If not, that can come back to bite you.
Yeah, thank you, Paul. That was good points.
So our next question is, should you be contributing to both a traditional retirement account and a Roth retirement account at the same time?
So this goes back to the conversation that you had chat about the diversification. So because we don't know what the tax rate will be in future years. So it's a good idea to diversify your retirement accounts and contribute to both pre-tax accounts and Roth. So in case the tax rate are increased substantially in the future, you can take a benefit of the Roth 401ks.
I would just add to that. It really depends, on your situation. I agree having both levers to pull for tax management. And yes, you can do them at the same time. So it just depends what's your tax rate today. Do you need those tax deductions for a traditional? If not, you do all Roth, and vice versa, or you can do both. It's just really specific to your situation.
Yes, and also keep a check on your income brackets, tax brackets, to see where you're falling. In case you're in between income tax brackets, it's a good idea to contribute a little bit more to your pre-tax to drop you to the lower tax bracket.
Great, gentlemen. So next question is, I'm already age 64. I would like to retire by 64 and a half, so about 6 months, but would like to work part-time, much lower paying job until about 66 and a half, and then draw Social Security, almost at the contribution limit and catch-up limit for the year in the next few months. Should I open a Roth and get my limit of that contribution in two before I retire?
Yeah, I think this goes back to the slide you presented on, Chad, about the 5-year clock that you need to get that started. So if you want to draw on that Roth, at least get that 5-year clock started.
Yeah, that's good. I know there's another question in the queue actually about how that 5-year clock works. So let me explain that a little bit. So basically, it's based on your first contribution. It applies to no contributions after that first contribution. So say you deposit $10 into a Roth IRA on July 15th, today after this call. The 10-year clock would actually, or the 5-year clock would start today, really January 1st of 2021. So you actually get a 7-month kind of head start. And that would all be eligible, even if you make contributions next year, the year after, the 5-year clock starts. The year that you make that contribution does not apply to any future deposits to that account. So to take that even further, you can actually start investing in a Roth IRA, say December 27th of this year. And as long as the account is open and funded in 2021, whether it was January or December, the 5-year clock started January 1st, 2021, no matter what. So you actually really, if you deposit in December, it's more like a 4-year clock. It's something to keep in mind. It does not apply to future contributions. So the next question we have in here, how long after I retire can I leave my money in my employer-sponsored retirement account? So I can take that one, gentlemen. The answer is until whenever you want, assuming that you have more than $5,000, which under $5,000, an employer can actually push your assets out, either write a check or put it into an IRA for you. If you have more than $5,000, your employer actually cannot push you out of their plan, and you can leave it in there all the way through retirement. It's actually becoming relatively common for some people these days just to start, monthly installment from their retirement account in their 401k, 403b, 457, and just take those monthly installments as their new income and leave their assets and continue to grow within their retirement account. Right. So that's something you definitely want to talk to your accountant, talk to your financial planner, financial advisor, just to figure out the best strategy and do a cost benefit analysis, like Arash mentioned earlier, figure out what's the best option for you. I think, like Mike mentioned earlier, at age 72, for all of you that have not retired yet, you would be required, if it's a Roth account, to take required minimum distributions, traditional account as well. But if you roll it into a Roth IRA, you do escape those RMDs, because Roth IRAs are not subject to required minimum distributions. But again, that could come with other fees. Like, are you going to manage it yourself? Do you have options in the retirement account that you don't have in an IRA? So there's a number of things to consider before you decide to do something like that. So gentlemen, I'm going to pull one from the chat box this time, if you're paying attention to Q&A box. Is there an income match for individuals and couples for either traditional or Roth? And I know, Arash, you touched on that, but maybe let me go back to that slide real quick.
Yes, if you could pull it up, that would make it easier.
And so this is the slide what mentions, I think this question actually came in before we got to this slide, but just as a refresher for everybody, in traditional IRAs, there's an income limit on the left-hand side. Roth IRAs, there's an income limit to even contribute to it. Really, all on the left-hand side to get the tax deductibility, on the right-hand side to even make a Roth IRA contribution. None of those income limits affect anything that happens in an employer-sponsored retirement account. These are only specific to IRAs. There are no income limits in an employer-sponsored account.
Yeah, and I just want to point out on the left, that's in regards to tax deductibility. You can always make a IRA contribution, even if you're over those thresholds. It's just not tax deductible at that time.
So the next question we have for you gentlemen is, what are the key differences between a Roth employer account, like a 401k, 403b, 457, and a Roth IRA?
So if you go back to the last slide before this, Chad, we can see the income, how much you can contribute to these different accounts. So for a Roth account, the income limit is $19,500, and if you're over the age of 50, the limit is $26,000. But for IRAs is $6,000, or if you're over the age of 50, $7,000. So you really have a lot more. You're able to contribute a lot more with the retirement plan Roth accounts, basically.
The other big thing, the big difference between a Roth 401k and a Roth IRA is a Roth 401k does have a required minimum distribution when you reach age 72 upon retirement, whereas a Roth IRA does not. But there's a loophole, and you can get around that by rolling that Roth 401k over to a Roth IRA, and then you avoid that required minimum distribution.
So the next question, I think, is just somebody being fun and poking at us, is can we define young with many years to invest? And honestly, from my perspective, I consider somebody that's 65 or 70 young with many years to invest. So I think the biggest thing is when you're thinking about whether to contribute to Roth or pre-tax, when Mike said young and many years to invest, it's really about your income, right? I think the bulk of people out there make less in their early years, make more as they get closer to retirement. That's obviously not always the case. But honestly, I think there's a misnomer out there that when you turn age 65, you're going to stop investing, right? Like, that's my balance and that's it. I'm going to pull it out, put it in cash and retire and start using it. The reality is you're only going to pull a portion of your retirement accounts out every year to live on. The rest of it's actually going to continue to grow. So there's some instances, if you've been a great saver and have saved a lot of money in retirement, you might actually see your balance continue to grow in retirement, even taking money out. So say you only need to take 4% out and your portfolio is up 6%, you might actually have an ever increasing balance while you're in retirement for some period of time, right? So I think young and many to invest is everybody's young with several years to invest until you're about to pass. The next question we have, gentlemen, gets into Roth conversions. Does the money in a Roth conversion contribute to the annual contribution limit to your Roth IRA?
So Rosh, you want to take that one?
I believe it does not, no.
Yeah, correct. It does not. It's a separate factor. It does not affect the contribution limit.
So the next question is, I think we already addressed it, the difference between in-plan Roth and a Roth IRA. So I think we just addressed that. Next question is, if you have an employer-sponsored retirement account, such as a 401k, at different firms, so you're working at multiple places and multiple companies, do you advise to move your money from job to job as you go, or keep them where they are? I think that it really depends on you as a personality, right? So if you can keep track of all of them, then it really gets into finding out which plan is the best, right? If you have a hard time keeping track of those accounts, it definitely is simpler or easier to roll every account into one or roll them all into an IRA, because it's easier to keep track of one or two accounts than it is 4 or 5 different employer-sponsored accounts. But say you moved from a very large company with a really robust retirement plan and really inexpensive options, and maybe you moved to a really small company or boutique shop, and maybe it's a smaller retirement account, right? And maybe the big company had $500 million in total assets among like 5,000 employees, and the small employer only has 50 people and there's only $1 million. Well, due to economies of scale, the former company likely has a much less expensive retirement account and lower fees for you to pay, where that smaller company might cost a lot more. So there definitely is an analysis you want to do on each of the plans to make sure that you're not taking all of your assets from a really inexpensive, well-run account and moving it into a more expensive, less efficiently run portfolio. The next question we have is, if you're over age 50, can you max out your retirement account at $26,000, right? And then if you wanted to also max out your post-tax Roth IRA contribution of $6,000, what's the max income level for married couples to allow this savings vehicle?
So in regards to that, just keep in mind about the combined traditional Roth contributions cannot exceed the maximum. So in combined, you cannot put more than $26,000, and there is no income limits for couples when it comes to retirement plans. The income limits we discussed are more applicable, or just applicable to IRAs.
That is correct. So for that married couple, you're looking at upwards of $125,000 combined to be able to make that contribution into a traditional IRA, or $198,000 to $208,000 to even be able to contribute to a Roth IRA. But you'd always be able to put that $26,000 into your employer-sponsored retirement account.
Again, that's just tax deductibility. You can always contribute over that, just not get the tax deduction.
So our next question, gentlemen, is, are you allowed not to distribute any retirement plan assets or IRA or pension after reaching age 72 if you are still working?
Yes, yeah, you can avoid the required minimum distribution if you're still working. But there are, you can't be, Paul, maybe you can chime in. I think it's 10% owner of the company, or you're going to have to start taking required minimum distributions. Are there any other factors, Paul, that you know off the top of your head?
None that come to mind.
Okay.
The ownership percentage is a factor, so it is either 5 or 10% if you're owner, then you would have to, can't recall exactly the percentage.
Yeah.
So our next question, gentlemen, I'm going to pull it from the chat box, says, if you are already age 60 and you want to open a Roth account, is it okay to do? And I think that gets back to, I think, my comment of, if you're already 62 because of that 5-year window, maybe not the best idea. And absolutely, you can always open that Roth account, assuming you're within the income limits to do so. It's just a matter of understanding that before you take any money out of it, you're going to have to meet that 5-year window. So you can drop money into the Roth account. Just know that you don't want to need to take it out no matter what. So make sure you have enough assets not in that account once you fund it to survive off of in retirement until that 5-year window is met.
And I would just add, I mean, you can always open a Roth at any age to do a Roth conversion. And then going back to the earned income for contributing to an IRA or a Roth, earned income is, I mean, income you get from your job or self-employment income or something like that. It is not Social Security or pension income. That does not qualify as earned income.
So our next question, again, gentlemen, coming from the chat box is, does a Roth conversion meet the RMD requirement to avoid the actual withdrawal?
No, unfortunately.
That's a really good question, though.
It is. Yeah, I wish that'd be nice. But no, it does not. You still have to take your required minimum distribution. So if you're, say, your age 72, you're taking that required minimum distribution and you wanted to do a Roth conversion, you've got ordinary income from the required minimum distribution, and then you've got ordinary income from the Roth conversion. So again, working with your tax professional or your advisor and going through what that's going to look like tax-wise is important.
So our next question, back to Q&A box, is what's the significant difference between an after-tax and employer-sponsored account, such as a 401k, 403b, et cetera, and a conventional investment that you just potentially don't touch until retirement? And so again, as a refresher, there's really, for some people, very few employers offer it, but for some people, there's a third bucket, right? You have traditional pre-tax, always available in an employer-sponsored account. You have Roth, which is after-tax and tax-free earnings, right? And tax-free withdrawals. And then for some employers, they also offer a feature called after-tax. And the biggest difference between an after-tax inside of your plan versus just opening up an account at Schwab, Fidelity, TD Ameritrade, like a regular brokerage account, is that inside the plan, that after-tax bucket, while you paid taxes, right? The earnings are not tax-free like Roth, but they do grow tax-deferred, similar to a pre-tax bucket, right? So you already paid taxes on the money you contribute to it, but all the earnings will basically grow and compound in your account and your investments. And then when you withdraw those assets, you're going to pay taxes based on your ordinary income. Where in a brokerage account, say you buy a stock or you buy an ETF or buy a bond, right? All dividends are taxable. Each year, you're going to get a 1099 from the investment provider. If you sell a stock, right, you're going to pay capital gains. So depending on how long you hold it, less than a year or more than a year, it could be short-term or long-term capital gains, which have different tax rates. And so it really turns into, you want to pay taxes on every sale, right? And every dividend or every income from fixed income, that's going to be in your outside brokerage account. If you want to defer all of those taxes on earnings and dividends, et cetera, then you'd want to do it in the after-tax account in your employer-sponsored program.
Yeah, and that actually is a good point, Chad. And that opens up the door, if the employer allows it, doing a strategy called the mega backdoor Roth contribution. So just like you do a Roth contribution where you put the money in after tax and then immediately convert it to a Roth IRA, some employers will actually allow you to do that in the 401k. And that is not like 5,000, that could be potentially another 20,000. So.
Yeah, so for that, Mike actually gave me, we did a blog post a while back. I just posted it in the chat box for anybody interested, that knows you have after tax available in your employer sponsored account. That really talks about what that mega backdoor Roth conversion feature is. I think a lot of the retirement plan providers are making it really easy to do so if you have access to these features. The next question comes from governmental plan 457. Can you move regular 457 funds into a Roth 457, or is Roth 457 used only for new funds? And so again, that goes back to, it depends on if your employer opened up what's called the Roth conversion inside of their retirement account. So not every employer, it is allowed in all 401k, 403b, and 457 plans, but not every plan sponsor has made Roth conversions an option. I think mostly due to complexity and the fact it's irrevocable, and they're afraid that some people might do this and not realize they have to pay taxes from their savings account, not from their retirement plan, and it could be a huge burden for some of their employees. So you definitely want to check with your employer and see if that's something that's available to you. And assuming it is available to you, then absolutely yes, you could do a conversion. Otherwise, it would only be for new funds that you're saving. Next question is, if you have an after-tax retirement contributions in your retirement account, can you convert them to a Roth tax-free? Technically, no. But I think a lot of providers today are allowing you to make after-tax contributions and almost immediately convert them, if not like the next day convert them. So your tax liability would essentially be the difference in time between what the investment made the day you contributed it to how much was in earnings by the time you converted it the next day. And so you might have a day of earnings that are taxable. But at the end of the day, a lot of providers are making it really easy to contribute after tax, and they will almost immediately convert it to make sure you only pay taxes one time on those assets and on very limited earnings. So next question is, what is your take or advice on cryptocurrency? Gentlemen, let's be light on this one today.
Well, the SEC and other regulators are very cautious about putting that in retirement plans, just because it is very speculative and volatile. So that's as far as my take on it. I mean, it's just like I said, it's volatile and it could be, I mean, good in the long run. It could be a bust in the long run, and it's just a lot of moving parts. So we can, maybe that person can reach out to us offline and we can talk more about it.
Yep, great. I own some too, guys, but it is a very small piece of my overall portfolio. Definitely make sure it's discretionary when you think about what these programs are. So just got one thumbs up. So I got the next question, gentlemen, is say I retire and I have a bit of extra money available each month to save, and I'm not taking any withdrawals yet. Where is the best place to save this money? Where can I save monies that I have to take when I need to take RMDs if I don't need the income yet?
Yeah, I mean, if you're maxing out and taking advantage of any matches and maxing out your retirement, I mean, if you fall within those income limits, which are up on the screen, I mean, doing a Roth is great. Maybe a health savings account would be, if you have a high deductible health plan, as another option. But if you're over all these income thresholds, just a typical brokerage account, which we spoke about earlier, which gets taxed every year, but it's going to grow based on your underlying investments in the account.
Yeah, and keep in mind that if you're thinking about contributing to IRA or Roth IRA accounts, you have to have earned income. So that's something to keep in mind. Otherwise, like Mike mentioned, you can put in just an investment account and continue to invest.
Yep.
Chad, you're muted.
Yep. So the next question I have is, with all my deductions right now, I'm in the lowest tax bracket of 12%. I expect in retirement with Social Security and no more than 4% yearly, my taxable investments to remain in the 12% bracket. Hence, I don't need to convert any more money to a Roth IRA to avoid taxes. Is there anything you see that's wrong with these plans to just kind of stay put?
I mean, it's one year that's based on current tax rates. So what's your outlook for taxes increasing by the government? And we're was it July 29th, Chad? We're having the future of retirement in America, where we're going to touch on some of that. So it's also your outlook on taxes as well, is another factor.
Yeah, I think we typically try to stay away from the politics thing on these webinars, but the last of this 4-part series on July 29th at 10 a.m. Pacific, 1 p.m. Eastern is a discussion where we have, I think, Ted McCann, who's the former advisor to Paul Ryan, former Speaker of the House, who's actually going to join us as a guest speaker to help host that with somebody else from BFSG that will kind of get into the future of retirement in America and hopefully answer some of those questions. But it really turns into your outlook, right? If it's pre-tax, you're going to pay whatever the income tax rates are when you take that money out based on the new tax tables, where if it's Roth, you pay all, at the end of the day, all of it's paid with today's tax rates and tomorrow is irrelevant. The other thing is just legacy planning too, right? If you are planning to leave assets to your heirs, converting to Roth means you pay the current tax rate, whereas if you keep it pre-tax, give it to them, then they're going to end up taking those assets at their tax rates. And so it could be a big benefit to be in the lowest tax bracket, convert it to Roth if you're planning to leave it to your heirs.
Yeah, I mentioned that before. It's a great, Roths are a great legacy planning tool because you can leave that to the heirs, and when they start taking withdrawals on it, they don't pay taxes on it.
So the next question we have is, what's the max you could take out of a employer-sponsored account like a 401k, 403b, 47 for college for children?
There's, I mean, no max. It's as long as it's qualified education expenses. Again, student debt does not qualify. So think tuition, books, that kind of stuff would qualify. So there's no max to avoid the 10% penalty. However, a withdrawal will be taxed at your ordinary income tax rate. So you want to be strategic about that. If you are withdrawing from a IRA for those qualified education expenses.
So Mike, if it would also be subject to the 10% penalty?
No, because it's gonna, for a IRA, it will, if it's qualified education, you'll avoid the 10% penalty.
What about an employer-sponsored?
For an employer-sponsored, yes, it would be subject to the 10% penalty.
So the next question we have is, so if I'm unhappy with my Roth provider, can I change providers without waiting for the 5-year clock to start over?
Yes, if you already opened a Roth, say with, not to throw anyone under the bus, say you opened up a Roth with Wells Fargo, that already started the 5-year clock, and then you open up a Roth, say with Schwab, that doesn't matter. The 5-year clock carries over. It doesn't start over.
You can move the account, it wouldn't matter. If you move your account to another institution, it would be fine.
Yeah.
So next question is, if I've already contributed $77,000 to my employer-sponsored account, how much can I put into a Roth IRA? I'm 54 years old, and let's, for this sake of question, assume they're under that 125 income limit.
So again, it comes, if I can.
It's that the answer is you can contribute up to $7,000 in the IRA too. So the IRA max is, for anybody over age 50 with catch-up contributions is $7,000 to either type of IRA, traditional or Roth. And since you only contributed $7,000 to the employer account, you can actually max out the IRA at $7,000 too.
That's correct. And I'm assuming they have the earnings. That makes sense. Yes.
Correct. So the next question is, you assume me and my spouse, proactively put $7,000 in each of their Roths for 2021 when we did our taxes, did not foresee exceeding the max income for 2021. But now it looks like we might go over the $208,000. I can withdraw the excess contributions, but what happens to the capital gains we've already realized? That's a good question.
Yeah, you want to make sure you withdraw it. If you're going to have excess contributions, you withdraw those, because the penalty is 6% per year that excess contribution stays in there. So you can withdraw that, but you have to withdraw the excess earnings as well, and those are taxable. And it, depending on your age, might have a 10% penalty as well. So work with your tax professional on that.
So the next question is, are you able to borrow from your retirement plan or IRA and pay it back? If so, how long do you have to repay it? And so, I mean, go ahead, Arash.
Oh, I was just going to say, for retirement plans, you're allowed to borrow up to $50,000, and I believe the payback period has to do with the plan itself.
Yeah, so that, yeah, it's basically it's $50,000 or 50% of your account balance, whichever is less, right? So if you have more than $100,000, you can only take $50,000. But say you only have $80,000, you can only actually withdraw as a loan up to $40,000. The payback period for a standard retirement plan loan is 5 years maximum. If it happens to be for the purchase of your primary residence, you can actually extend it out to 15 years for a payback period. But for most traditional retirement plan loans, you're looking at 50% of your balance up to 50 grand and 5 years maximum to pay it back. You can always pay it back at less than 5 years, but 5 years is the maximum payback period. So the next question, gentlemen, we have is, how much can somebody be on this call, be it here or otherwise, any other advisor, to expect to pay for a financial planner?
I would say, I mean, it's really specific to your situation and how complex it is. So you can reach out to us directly to the financial planning at bfsg.com address. But I mean, typically you're looking anywhere from, for a very basic plan, $1,500 to upwards to $10,000 for a very, very complex plan. So it's really specific to your goals, objectives, needs, and how complex the planning is.
Yeah, I think those ranges apply, like whether you're talking about one of us here at BFSG or any other financial planner, those rates are relatively static across the industry if you were to interview somebody else as well.
Yeah.
So the next question is, which I think we addressed, but I'm still going to answer it because they might have missed the original question if this person came on late. Is a Roth retirement account, employer-sponsored account such as 401k, subject to RMDs? And the answer is yes. The only way to get out of those RMDs would be to roll it into a Roth IRA, which is actually not subject to RMDs. But if you leave it in the employer-sponsored account, it would be subject to RMDs. The next question, gentlemen, is are there any restrictions on how much money from a Roth employer-sponsored account can be rolled into a Roth IRA to avoid those RMDs we just addressed?
No, there is not restrictions.
Yep, that's correct. The next question, so again, just that was not, in case that was too soft for everybody, you can put as much money as you want from a Roth employer account into a Roth IRA. Next question is, can I put the max retirement plan contribution of $26,000 or say $19,500 plus max out a Roth IRA for $6,000? So this person's under 50,000 or 50 years old. So say retirement account of 19.5 plus Roth account in an IRA. Are they able to do so?
So this again goes back to your income limits that we have on the slide here. So if you are below these income limits, you're able to do so, and as long as you have enough earnings. So as long as you're made more than $25,500, and also you are below these income limits on your right-hand side, you're able to do the extra $6,000 into a Roth IRA.
So next question is, I'm in my 30s and I have an old retirement account from a previous employer. Should I let it sit and earn interest, or is it better to convert it to a Roth IRA now? My partner also has his own separate Roth.
I mean, it goes back to your outlook on future taxes. If you're going to be you think you'll be on a higher future tax bracket, or just your outlook on taxes in general. So that's one factor. And again, it's nice to have tax diversification for that tax bracket management. So when you do retire, you can manage that tax bracket by pulling some from pre-tax and some from after tax. So it's really specific to your situation. But if you think your income's going up, you're say 30 now, and you think your income's going to continue to grow, and you're going to be in a higher tax bracket, then it might make sense to do that.
So the next question is, are all Roth IRAs within an employer-sponsored retirement account, or can you open a Roth IRA as part of your own personal retirement planning? And so the answer there is technically outside of like very small employers with things like SEP IRAs and whatnot. For more traditional, 401k, 403b, 457 plans, it's not actually a Roth IRA. It's actually called an in-plan Roth. So it'd be a Roth 401k, Roth 403b. It's in the exact same account as your traditional assets. So if you've already saved pre-tax, you start saving Roth, your account balance will grow exactly the same. And the provider would actually split it out and show you how much you have traditional, how much you have pre-tax. They'll also show you if your employer matches or makes a contribution, that goes in pre-tax. They'll show you how much your employer has saved as well. And so an IRA is actually only an individual retirement account that you would use for your personal financial planning purposes, right? So say you have a 401k, you save Roth in the 401k, and then you'd open up your own personal IRA to save on the side outside of that account. The next question is regarding the caveat on I think it's the current slide with income limits regarding if the spouse is covered by a plan and I am not. Is that the same the other way around? If I am covered and my spouse is not, is our income limit the same for the traditional IRA?
Yes, the incomes are the same. Keep in mind that if you're covered and your spouse is not, he or she can contribute to their IRA account.
Yeah, that's correct. So it's exactly the same either way. We couldn't figure out an easy way to put that on the slide and make that very clear. So the idea is one spouse working and covered, the other spouse not, no matter which one it is, those limits are exactly the same. The next question I have is, so thinking about these income limits, what if we're married but filing separately? Are they the same?
I believe they're not the same. We just didn't want to confuse our guests by putting too many limits here. But we can, if you reach out to us, we can double check and let you know.
Yeah, I think that's a good question. I don't know that we have the answer on the top of our heads for that. If you're able to shoot one of us an email. Again, my email is chadn@bfsg.com. I just put it in the chat box. And if you shoot that question out to me after this webinar, one of these gentlemen will give us a response and we'll get back to you as soon as possible.
The answer is much lower.
Yeah.
Look at that.
0 if the phase out for an IRA deduction for active participants is $0 to $10,000.
There you go. That's an answer. So definitely a much lower contribution limit for those participants.
Yeah. Sorry, I had to look that up. That was a good question.
So the next question is, we mentioned only posting 4 sessions. I'll only offer 3. Can you please post the dates, times, and descriptions? Yeah, I'll grab the link in just a moment and drop it. That we'll also include it. There will be a follow-up email. You'll get one from Zoom directly, and then we will actually have one out tomorrow to everybody. In that email we send out tomorrow, we will include the dates, times, and registration links for both the next 2 presentations. The last one, we actually had one last week. So if you happen to miss one last week, there is only this one, 2 more left. But we did have one last week going all the way through July 29th. The next question is, what are the benefits and cons of rolling over an IRA into your employer-sponsored plan, like a 401k?
Yeah, that's a nice question to wrap up on. I think it's the last one. That's a great question. So yes, you can do the opposite. You can roll over from an IRA into a 401k or vice versa, 401k to an IRA. The same things that apply. I mean, what's the cost benefit analysis? Do you have cheaper options in the 401k versus the IRA? Do you maybe more limited options, or do you have a brokerage link window in your 401k? Are you getting financial advice? What are those types of things on your IRA versus 401k and financial planning around that? So there's just those kind of factors to consider.
Yep, 100%. I concur with all of that. And so again, for that person asked about the future webinars, if you prefer not to wait for our email out tomorrow, I did once again post in the chat box those same 4 links I posted earlier: link to our survey, a link to register for next week's healthcare retirement presentation, a link to the PDF of today's slide deck, and then the last link to BFSG University. All 4 sessions are actually posted at that link, bfsg.com/BFSG University, and that will give you the date, time, and the registration link if you'd like to do that video as soon as possible. With that in mind, we want to thank everybody for their time on today's presentation and for tuning in with us. And I hope you all have a great day.